Welcome to Ticker Talk. I'm Ted Ohashi, coming to you today from the offices of InvestmentPitch in Vancouver, British Columbia. I'm pleased to have back with me as my guest Steve Vestergaard, President and CEO of DSNY Media. Welcome, Steve.
Yeah, thanks, Ted.
It's only been 3 months since we talked. You must have a lot going on.
Yeah, it's been a really busy quarter. There's been a lot of things that set up this quarter that are going to help us jump the chasm next quarter.
Okay. I mean, one of the things that's happened this quarter is your stock performance has improved. And I noticed that your company, and you in particular, you've made a commitment to sort of do investor relations work to get your story out there, to get investors aware of DSNY.
Yeah. So historically, we've been a bit under the radar. So for the last couple of years, actually, we've not done a whole lot of investor relations, not done a whole lot of PR. And the reason is we wanted to get, especially our Clipstream product, we wanted to get it ready for launch. We didn't want a lot of eyeballs on it until the technology was rock solid and that we're confident that it worked well. And we're worried about protecting our intellectual property. So we wanted to get our patents in place. So we have 7 patents pending now, so that's all locked down. But we also wanted to get a bit of a head start. So we wanted to make sure that if somebody competitive, wanted to start building this, that we're out with a working product, long before they're ready to start development.
So what are some of the things you've started to do now? I mean, you're going out to conferences and... Yeah,
exactly. So I've started to tell the story. I've been going out and meeting institutions face to face. We're doing quite a few investor relations conferences or investor conferences. I'm doing the Ideas Conference in Chicago next month. I'm doing a roadshow in Toronto in August, and also another one in New York. So we're getting out, we're starting to meet people, we're starting to tell the story. We also hired a PR company, and we hired the PR company and then told them to hold their horses and not do anything because we hadn't been quite ready for them. We are now, and looking into September, we're expecting to start getting a lot of news coverage. When our first product launches, we're going to be screaming about it from the rooftops. We're going to make sure that everybody knows that the product's available. So
you were telling me. Oh, sorry.
Yeah. So we're kind of coming out of our shell.
Right. You're telling me also that internally you have some programs like for investors, share purchase programs and share buyback programs.
Yeah. The company's been pretty aggressive. During the quiet period when we weren't telling our story so aggressively, we thought that the market cap really didn't represent the value of the company. And we're generating good positive cash flow off our core business, the Play MPE product. And so we just took that cash flow and we plowed it back into buying back our own shares. So we've repurchased about 5% of the outstanding and canceled them. That program isn't active now. That was available up until to a $1 share price, and we're trading much higher than that now. We also have an employee purchase program. And I'm pleased to say that almost every employee is taking part in the program. And so what it allows them to do is to take up to 5% of their salary, deduct that off their paycheck every 2 weeks. The company matches that to bump it up to 10%, and then the company actively purchases out of the TSX market. And in each 2-week period, those shares are allocated to the staff. And there's a 1-year hold on whatever is purchased. But it makes the staff, owners in the company, and it makes everybody's already proud to be part of our successes. But there's that economic, incentive too now.
Well, I would say, in spite of the fact that your shares have gone up a lot recently, your market cap is just starting to reflect what's already there, and hasn't really appreciated the blue sky yet. So let's get into a discussion of some of that. Tell us a little bit about your business.
Yeah, the market cap still doesn't reflect the value of the Clipstream technology. I don't think people really realize just how disruptive the technology is. But as we go out and we tell the story, people are starting to get it. So we're up. I think in the last 20 days we're already up 40%. So people are starting to understand that the technology is quite valuable.
Okay, so now your company, DSNY, is in a unique position because you do have a product line that is profitable and creates cash flow for you.
That's right. The core Play MPE business is a bit of a cash cow. So what Play MPE does is securely distribute music, pre-release music for the record companies. Typically they're going to radio stations, but that's the tip of the iceberg. There's much bigger markets for journalists and DJs and other recipient types that get free music. But that system's completely automated. There are big fixed costs, on the order of $3 million a year. But once those fixed costs are covered, the variable costs are negligible. Our costs are similar to the cost of sending out an email. So on an incremental basis, our new business is almost 100% margin. So we're generating positive cash flow now, but as we double and triple the Play MPE business over time, most of that new revenue is going to go straight to margin. So what that's been able to do is we've been able to take those margins and take those profits and plow them back into R&D. And so we were able to finance Clipstream. All the Clipstream development has already been expensed, against the Play MPE earnings. Our earnings would have been a lot higher if we hadn't, have been doing the Clipstream development. But we're now in a nice position that going forward, our only costs for Clipstream are going to be sales and marketing costs.
And even with the Play MPE product, this new contract kind of masks some of the growth that's taking place there, doesn't it?
Yeah, so we just, this one of the things that's happened this quarter is we entered into a new global contract with Universal Music Group. So Universal's merged with EMI, and now the combined entity is about 45% of the major label market. By and large, so this new contract replaces probably a half dozen previous contracts that we had with EMI, with Universal Europe, with Universal North America, and then with sub-labels in Norway, Finland, Denmark, Sweden, Australia, New Zealand, with different sub-labels, directly with sub-labels of the corporate parent. By and large, the new contract keeps all of the terms, the same pricing terms and everything, but there were some confusing things. The new contract's all priced in euros. So, what exchange rate do you use when you convert from the old US contracts to the new euro contract? But one change that has really impacted us is we were charging for users, for recipients that weren't actively using the system. And there was an unfairness to that. It was something that was agreed to and was in the old contracts. But that made it difficult for us to expand into new markets. We go into a market like Germany, and they'd say, well, why would we pay for users that aren't using it? And so we made the contract more fair, and that did impact us this quarter. So even though our usage was up, we were actually below the minimum, this current quarter. The good news is that's as worse as it gets, because that minimum revenue is guaranteed. Is guaranteed each month.
Let's talk now a little bit about the Clipstream, because it kind of had a bumpy introduction, right?
Yeah, people are really confused about what it means to launch the product. We launched a prototype last August, and people were expecting revenues out of the gate. I don't think they understood that a prototype is a demo of technology, in its earliest phase. So it was more like a proof of concept. So we launched that in August of 2012. In December 2012, we launched what we hoped was a commercial candidate. So we call that a commercial prototype. Unfortunately, it used too much bandwidth for many users and too much CPU. So people with older machines or on internet connections that were not necessarily high speed, we're having a lot of problems. We actually had a bit of a sell-off in the stock in December. If your CPU is not high enough, or if the bandwidth's not high enough, it would auto decrease the quality. And so a lot of investors were looking at the quality, comparing it to YouTube, and it didn't compare on slower machines. And yeah, it caused a bit of a sell-off. We fixed those problems, relaunched in February, and we chose 3 prototype customers in the market research field to pay us, and to actually do live surveys and to test the technology. They found some minor problems, things like centering with third-party software. When they integrate with Drupal, maybe something's a few pixels over. Those sorts of problems. Those have all been worked through now. So where we're at today is we have an engine that we think is rock solid. There is the odd problem, but nothing that's going to stop us from making money and selling it. And so we're taking the engine and we're building a number of products around it. Currently, only we can encode videos. What we want to do is put a product out there so that people can self-serve and make their own video content.
And that's really a good business model, isn't it? Because basically, once that product is out there, people just use it and pay you for the right to use it.
Yeah, exactly. Our only costs are going to be sales and marketing costs. The first product, we're going to provide hosting, so we'll have some bandwidth costs, but it's still very high margin. So the way the first product's going to work, and we're expecting it to launch in Q1, our first quarter, which is fall of 2013. Basically, the user will download an uploader application, and so their little icon will sit on their desktop, and they can just drag and drop videos onto the icon in any format. The uploader will automatically, secretly, if we don't draw attention to it, will automatically convert to our format and upload it to our cloud, our servers in the sky. Initially, we're going to actually wholesale hosting from Amazon. The reason we're doing that is just to reduce our risk and to make sure that if it's really successful or when it's successful, that we can grow as quickly as we need to. Once the content's up there, the user can just log into their account. They can play with settings, the width and height of the video, that sort of thing. And then they just take a link, a .js link, and they just embed that in their web page. And the video will show up in their web page or their email or their blog posting or wherever they want to put it. And it'll look like it's part of their page, but it'll be secretly coming from our cloud. So it's a YouTube for business type of model.
Right. And what that also allows is that no matter what mobile device or desktop device people are using, it will play.
Yeah, and I don't think people realize what a problem this is, because they go to YouTube, they upload the video, it just works, and it works everywhere. But behind the scenes, YouTube's got to convert into at least 3 formats to make it work. And the reason is there's not a standard for video across the internet. By comparison, our single format will play everywhere. And so we can match YouTube's hosting or match the way YouTube works, where you just drag and drop and it just plays. Yep. But behind the scenes, it's going to be way simpler for us. So we can use 1/3 the storage, for example, and we don't have all the conversion costs. And whereas YouTube has to pay to encode on their server, our uploader application will actually be using the client CPU, which allows us to really reduce our server infrastructure cost. And like I said, it allows us to use services like Amazon that really take away risk from us.
And this is just the first of a series of products that you've got coming down the line?
Yeah, we've been doing streaming since 1995. I think I mentioned to you we own streamingaudio.com. I remember registering that in 95 when nobody was using the term streaming. So we have a lot of experience. I don't think there's too many companies that can say they've been doing streaming for 18 years. But one of the things that I've found, or that we've found as a company, is that there's not one customer type. And we can't have one pricing model that works for everyone. It varies from the little Joe's hardware store where he wants to put a single video up on a web page, and maybe a few hundred people a month are going to see the video, to the other side of it where somebody's running an advertisement that reaches tens of millions of viewers. And the way you'd price those two things is very different. And so to segment the market, we've realized that we have to build different offerings for the different the different customer types. So to go after the different verticals, initially we're going to have this cloud-based product. Then we're going to have an encoder where you don't have to use our cloud. You can just put it up on your own web server, and it'll be compatible with any brand of web server. We're doing a server-based site license where people can, instead of using a desktop to encode, they can use a server on their corporate network. The idea is that'll allow them to automate the encoding. In that case, the videos will be tied to only play off their URL. So it'll be probably more of a flat monthly fee instead of a fee per video. Then we're looking at, we've got internet radio software that's coming out that'll automate putting internet radio feeds on, on the air. With our Play MP product, our other product, we've got 60-some thousand recipients that trust us, and so we, radio stations that trust us. So we plan to sell that product, into that vertical. We've got our market research product, which it just goes after the market research vertical where they do secure online surveys. And there's other products that we haven't announced that we're gonna keep rolling them out over time.
And some of those new products will start rolling out early next year?
Yeah, so the development is happening in parallel. We've got a whole bunch of projects in the air. We're trying to develop as quickly as we can. But the first one to launch will probably be the cloud product. It'll probably be the only one that launches before Christmas of this year. But really early in 2014, we expect the other products to start coming out.
I really find that YouTube for Business, I mean, yeah. it creates an exciting sort of mind image.
Yeah, exactly. We like that phrase because it really captures what the offering is. Everybody knows how popular YouTube is, and one of the reasons it's popular is because it's easy. You don't have to be a computer programmer to create videos. If you were to go to Google and search for video hosting as a search phrase, you'll find hundreds and hundreds of companies offering video hosting services. But I'm an expert in the field, and I find the offerings complicated. I can't figure out what it's going to cost me. They talk about so many gigabytes of storage and so many gigabits of transfer. How do you convert that? I mean, what does that mean in terms of what it's actually going to cost me per month? And then I have to do the conversions. I've got to put it into either Flash on computers or WebM or H.264 on devices, and it's a real big effort. By comparison, our stuff's going to be drag and drop. And right out of the gate, we're planning on launching in a number of languages. So the goal is the system's going to be completely automated, and we like every time zone to be using it. So 24 hours a day, people can come in, they can put in their own credit card information. The model's going to be like a cell phone model where they buy packages and it's a recurring monthly fee. It's all self-serve. They create the video. It automatically goes to Amazon, they embed it, and it doesn't take any of our staff time or any of our resources.
The other thing about DSNY that investors like, particularly in sort of semi-difficult times like now, is your financial position. Tell us a little bit about your structure.
Yeah, so we're debt-free. We don't have a whole ton of cash in the bank. We've got about 1.3 million. We keep our AP really current. Our suppliers love us because we usually pay our bills within a week of receiving the invoice. We've got a $600,000 receivable. We've taken a second mortgage on some property in Australia so that they make us monthly payments on that. We have the ability to raise money at any point of our choosing. I get chased to do financings on a daily basis, but we don't think it's in our best interest today at the current market cap. We don't really have a use of proceeds. Neither of the businesses are cash intense. In both cases, we can grow usage, out of revenues. At some point, it'll make sense for us to strengthen the balance sheet, but to date, it hasn't been required. We've been very sensitive about dilution.
Well, Steve, that's a fantastic summary of a great company that is finally being recognized a little bit in the marketplace, and based on what you've said, I mean, I think that's going to continue.
Yeah, no, I appreciate that, Ted.
Thank you for being with us today, and from the offices of InvestmentPitch.com in Vancouver, British Columbia, I'm Ted Ohashi.